Hello and welcome to the Monday edition of Market Briefing. I'm Martin Bakkerdax, European business editor here at the IB Times UK. We're looking at regional equity indices backing off some of the multi-year highs today. The declines are modest, but nonetheless they do represent a little bit of investor concern for the macro conditions that they're seeing not only in the United States but here in Europe as well. We'll start with Europe. We had a much better than expected reading for the trade surplus of Germany, of course the largest economy in the region, but that was really offset by the disappointing data that was reported today out of Italy. The full-year contraction for the Italian economy, third largest, it has to be remembered, in the whole of the Eurozone, was measured at 2.8%. That was deeper than first anticipated and measures an even steeper contraction than most people were assuming. Now that probably tees up an even deeper contraction into 2013 and has investors worried about how that, coupled with the political stalemate, will impact financial markets. Now, we'll get a stern test to that as early as Wednesday because the Italian Treasury has to raise about 9 billion euros in 4 separate bond auctions. Now, that would be complicated enough. It was complicated further by news late Friday that, of course, Fitch Ratings had downgraded its assessment of the Italian economy by 1 notch to BBB+. It has that rating on a negative outlook, which means in the near term it could fall even further. Now, it has to be said that while Italian bond yields did rise today, as did credit default swap prices, which insure bonds against default, the rise was actually not that large, and it does suggest that investors are positioning themselves for positive news on the political front. That may seem impossible to believe right now because Parliament won't convene until Friday and the President won't begin negotiations with party leaders until next week. But the assumption from investors does seem to be either that A, they'll get a new vote and that will probably streamline the situation with respect to political leadership in Italy, or B, if markets do get a little bit out of control, that the ECB will be able to step in, of course, with its backstop outright market transactions program. So we'll have to wait and see, but at the moment the movement doesn't seem to be that significant. We're seeing sterling around a 2.5-year low. It's a grim outlook, as you might imagine, for the UK economy, and that will probably be underlined by the March 20 budget statement from Chancellor George Osborne. What was interesting about that with respect to at least one of his principal platform positions with respect to banking reform is that the Parliamentary Banking Standards Commission today reiterated its concern that Mr. Osborne won't go far enough in forcing banks to ring-fence the activities of their retail bank from their riskier investment bank. In fact, the PBCS today said that unless all of the banks comply with the ring fencing to the degree that they find comfortable, then all of the banks should be split up by the government as a result. So it does seem to be an all-or-nothing condition that parliamentary experts are asking George Osborne to consider, and they're concerned that he's going to water that down a little bit more, maybe understand a little bit more what he's going to do later today when there's a second reading of the banking reform bill in Parliament. Another thing worth looking at today, I think, again, is simply what's happening in currency markets. We are seeing, as I say, sterling a little bit weaker today, but by and large, the currency machinations have settled a bit, and I think it does probably represent a little bit of a pullback of risk from investors. And again, that's kind of represented in what we're seeing in equity indices as well. We'll keep an eye on all of it, of course, throughout the day, so do come and visit us at the IB Times Economy page, and we'll see you on Tuesday.